Hey friends, Raul Jimenez here with the Schrader Group. I'm here with Tom Romanello with Legacy Mutual Mortgage, and we're going to hit in with some questions as far as what's happening with the mortgage industry and all the pre-qual. So thank you so very much for being here.
Thanks for having me, Raul. Really appreciate it.
Absolutely. So let's just dive right in. The biggest question I get when I'm showing houses or thinking about the process is pre-qualification. Should we go? I always say it's a Willy Wonka ticket, right? Once you get the golden pass, you're ready to go. Let's just kind of jump into that and the big difference between why it's so important to get going with the pre-qual.
Well, if you look at the pre-qual versus the pre-approval, okay, it's really pre-approval, and that's what we really strive for.
Okay.
And that's when we take a look at the client's, all their information, documents and data. In order for that to be effective, we have to see everything, run through the system, and ensure that they're good to go. And the real reason you want to do that is when you go to make an offer, that listing agent and that seller, they want to know that you are good to go,
right,
that you can go ahead and move forward with the purchase of the property. Also, as far as a consumer, you want to know exactly what it's going to look like, your payment, your closing costs, what the whole process looks like. And you want to feel confident when you make that offer that you're going to get that home.
Well, and part of what I require about it, because I won't get into showing homes without the pre-qual or pre-approval, the fact that when I do submit, especially in this tough market, that they can have that lifeline to call the lender and say, hey, everything's good, and I don't want any surprises coming up like, well, they're kind of good because of this or that. But if they pay that off, they're perfect. It kind of makes the seller a little bit worried. So it's one of those things I like to get ahead of the game. Now, what are some of the steps to get pre-qualified? Because some people get scared. You send them a link and they're like, I don't know, I could barely, leave a Google review sometimes, or I don't even sign up to do my online banking. So what are the steps that go along with that?
Well, what we like to do is we like to touch base with the client and we give them the option.
Okay.
Do they want to give us the information on the phone or they want to go online? Okay. And we get their information, income, assets, credit, and we pull their credit, but we get authorization for that first. And then we set an appointment either in person or on Zoom to go through all their different options. So what they're going to do is give us their information. We're going to pull the credit. We're going to ask for documents, their income, which is W-2s, pay stubs, their assets, bank statements, and then, of course, work history and where they've lived.
So leading into all that, the next question would be, based on what you read and what you see, what loan would be best suiting for them, or what loan makes the best sense for them while educating them through the process. So what are some of the most popular ones that you entertain?
Well, of course, VA, FHA, conventional, and USDA. Those are your main loans that you're going to be looking at. And of course, you have what you call your jumbo loans, which are over the conforming loan limits, and then your non-QM loans. A non-QM loan would be a loan such as a bank statement loan or a asset qualifying loan. So those are the different ones, but mainly VA, FHA, and conventional.
Yeah, and VA, our city's military city USA, so we have 30 to 40% of our military folks that are buying, so VA is a huge benefit. But even going in a little bit deeper into that process, seeing like the differences of what's going on with the market, right? Some people say, well, I've heard of this ARM, right? The adjustable rate mortgage, and then now what's a fixed rate? And kind of the pros and cons about those two, if you wouldn't mind touching on that.
Well, right now, ARMs currently aren't as good as what your long-term fixed rates are, because we have an inverted yield curve. But when you look at a conforming 30-year fixed rate, that's going to be fixed for 30 years. An ARM adjustable rate mortgage, that's going to be fixed for a certain period of time. For instance, a 3-year ARM. 3-year ARMs are for 3 years, then they adjust. They may adjust every year or every 2 years. And it's going to be based on what the index is, which is like the Treasury. So you can have a 5-year ARM, a 10-year ARM, an interest-only ARM for more of the jumbo loans, and a lot of the high net worth people like those interest onlys for the jumbo because they either pay them off or they refinance them down the road.
That's funny you say that, because I have a lot of folks that are out of California, and with when things got really expensive and things got really tough, try to make those payments, they're like, we just do interest only because we've been historically growing at such a high pace that we don't have to worry about putting money towards principal. And I actually started to see some of that happen here in San Antonio to make those payments a little bit more manageable. Now, talk to me about the prepaid closings versus what you should be kind of looking for as far as your monthly payment, right? Because some people say, I can only go up to $2,500, so then we kind of have to re-navigate and work backwards to figure that out. And then what things that the seller can actually pay for.
As far as closing costs is what you're talking about?
Costs,
Okay, so on closing costs, it depends on the loan, depends on how much you put down. Conventional loans, if you put 3 or 5% down, then the seller can contribute 3%. If it's an FHA or VA, FHA 6% they can contribute, VA it's 4% of the sales price. So each loan is going to be a little bit different depending on how much you put down. For instance, conventional 10% down, they can contribute up to 6%. So those closing costs are really going to be based on a few things. Number one, you've got prepaids, which are taxes and insurance. So what are the taxes on the property? What's your insurance going to be? And then the interest from the day you close to the end of the month. The other closing costs are going to be determined on how that contract is negotiated. For instance, is the seller paying title? Is the seller paying survey? So those different things are going to come into effect. So you're looking anywhere from 2.5% to 3% closing costs, and that's without buying down the rate.
Right, and that's a climate we're living in right now. It's kind of a norm when we see the builders offering so much in concessions and rate buy downs. It's one of those strategies that sellers are using to say, hey, we can compete as well. Take a look at this. Hey, if you live within 410, you're going to have to buy a pre-existing home, right? So it's one of those things that we always take a peek at. Now, for most of our buyers out there, I always say the rule of 30, right? If we get under contract here, typically about 30 days is the soonest we could probably close. Is there any kind of differences between the loan products that make it a little quicker versus something that might take a little bit longer, or is the 30-day rule kind of on par today?
Your 30-day rule should be on par if everything is done properly.
Okay.
In fact, you could close in 10 or 14 days if you have all the perfect storm.
Sure.
But you don't always have the perfect storm, which means you have to have a good appraisal. You may get an appraisal waiver, which is different from the opportunity to go ahead and terminate due to appraisal.
Sure.
So most of the time, you should be able to close in 30 days.
So let me ask you that. You hit something on that one, the appraisal waiver.
Yes.
So obviously you can't do that with all products, but if you do have that opportunity, what are you looking at as far as on the lender side? Is it just the amount of equity that's there, or maybe more the down payment side? How do you equate whether you can or cannot?
Well, a lot of people think it's the lender's decision as far as that, but really it's the system's decision.
Okay.
So when you run it through the system, Fannie Mae and Freddie Mac, they're going to say, the system's going to tell you, we accept the sales price as the value.
Right.
And when you have an appreciating market, that sometimes doesn't happen. Depreciating market, you may get that. But what we're seeing is less and less of those right now. And the reason for that is because what's happening in the market. But that's not really the lender's decision. It's actually the system's decision.
So Tom, big question. Where do they find you? Where do they find Legacy Mutual?
Well, myself is tromanello.com. That's my website. But they can get a hold of me on my cell phone or on my office phone. Just Google Legacy Mutual in San Antonio, Texas, and you can probably find me.
Well, there you have it. If you have any other further questions, please feel free to reach out. If not, you'll have a blessed day, and we'll talk to y'all soon.